Welcome to Financial Insights in Minutes. Today, we're diving deep into potential systemic risks in the banking sector and what this means for investors like you.
That's right. We'll hear expert insights from Russ Hutchinson, CFO of Ally Financial, and Chris Vermeulen about the impacts of rising delinquencies and market volatility.
The latest economic data is alarming, and we'll summarize why these shifts might affect your investments going forward. Plus, learn how AI-generated summaries from our platform can save you time while keeping you informed.
Buckle up as we navigate these turbulent financial waters. We'll offer solutions and strategies for protecting your investments.
Don't miss the critical takeaways that could shield your portfolio in these uncertain times. Time to navigate through these waters. Today, we'll explore the depths of the banking sector's recent turmoil.
Here's the full scoop. Russ Hutchinson, CFO of Ally Financial, opens up about the current state of the banking industry and what it spells for the economy.
So what's the core problem here? What's got the financial community all riled up?
Hutchinson's major point is the growing concern over rising delinquencies and unemployment rates, which indicates a shift from previous optimism in the banking sector. This change could hint at a much larger economic downturn.
What did Hutchinson say about delinquency rates?
He highlighted a concerning uptick in delinquencies, especially in the auto loan markets. This isn't just a singular issue. It reflects broader economic challenges.
What impact are the Fed's policies having on the market?
The Fed's rate cuts seem like a last-ditch effort to stabilize the economy, but there's skepticism about their effectiveness in preventing a recession.
What's happening in commercial real estate?
The outlook looks grim. Banks are quietly trying to offload commercial real estate loans as interest rates rise, but they are facing obstacles in market liquidity.
And what's the market's reaction so far?
Bank stocks have taken a nosedive, some down by 20%, as investors grow wary of the negative outlook discussed by Hutchinson.
What does Warren Buffett's recent behavior suggest?
Buffett's ongoing sell-off of Bank of America shares stirs up worry. It begs the question, does he anticipate a market downturn?
Now let's peek into the crystal ball. What are the predictions?
Experts fear that rising delinquencies could lead to increased layoffs, pushing unemployment rates even higher. This is a cycle that could feed on itself.
How about the recession? Is it really on the horizon?
Absolutely. As delinquencies rise and consumer spending weakens, recession fears are becoming palpable. If conditions persist, we could see a real downturn.
What are the ultimate takeaways from this analysis?
In essence, we need to analyze the systemic flaws that have emerged in the banking sector. Clearer regulations and robust policies are critical moving forward.
What questions should we keep asking?
The big one: are we really prepared for whatever economic challenges lie ahead? What steps need to be taken to bolster our financial foundations?
Time to navigate the currents of today's discussion. We're diving into the financial reset buzz with Chris Vermeulen.
Here's the scoop. Chris lays out the market's current volatility and highlights potential panic selling and margin calls around the corner.
So what's the central theme here? What's got the financial world buzzing?
Chris articulates a critical thesis. The market is facing a substantial correction, driven by investors' shifting expectations, particularly surrounding upcoming Federal Reserve decisions.
Diving deeper, what are the key highlights Chris is making about recent market volatility?
Both the S&P 500 and Nasdaq are facing declines of over 1%. The unexpected CPI data has thrown a wrench in market confidence.
What's the Fed's influence in this scenario?
Chris highlights how market expectations around Fed decisions will shape investor sentiment. A minor cut could maintain stability. Larger drops might panic the market.
What's Chris predicting for the immediate future?
He forecasts a swift 4 to 5% drop in equities, pinpointing significant struggles since late August.
What's on the horizon for gold then?
Chris sees demand skyrocketing, projecting gold to reach $2,700, but he warns of potential corrections thereafter. This sharp rally could be short-lived.
And how about bonds?
Chris hints at a bullish outlook for bonds as equities falter, suggesting this could mark a critical recovery in bond market dynamics.
In conclusion, what are the takeaways from Chris's analysis?
Investors may need to adapt by shifting focus to defensive assets, especially in light of an unstable market. Chris's insights clearly indicate we're entering crucial financial waters.
Given Chris's insights, what's the smarter play for investors now?
Staying vigilant and adaptive, tailored to the shifting financial landscape, could be key for navigating uncertainty ahead.
Let's dive right in. Today, we're unpacking the recent market responses to the Producer Price Index, or PPI, and whether the bullish movements we saw were genuine or just a bull trap waiting to ensnare traders.
That's right, the volatility in the market has sparked curiosity, and what really stood out was the mixed signals the PPI data provided. Buckle up as we navigate through these financial waters.
So what's the heart of this PPI reaction? What should we be looking out for?
The core thesis here is that while the market reacted positively to the PPI data, significant underlying factors suggest this might be a deceptive bullish trend. We need to analyze these complexities carefully.
Let's break down what the PPI changes entail. What's the scoop?
The PPI indicated a slight decrease, which could suggest lower inflationary pressures. But hold on, the core PPI data actually pointed to persistent inflation worries, creating a mixed bag for traders.
And what about the market's reaction? What did we observe?
Initially, there was a wave of excitement, with traders riding on bullish trends. However, as deeper analysis emerged, skepticism grew about whether this upward movement could really maintain momentum.
What should we know about interpreting economic indicators?
Economic indicators like PPI can significantly shape consumer demand expectations. However, history shows similar patterns occasionally lead to market traps. Definitely something to keep in mind.
Let's peer into the crystal ball. What predictions can we make based on this analysis?
Traders should brace for a possible market correction as underlying economic concerns begin to surface. History reinforces that corrections typically follow exuberant bullish phases.
And what about future trading tactics?
Given these mixed signals, strategists must recalibrate their approaches. Expect increased caution as market dynamics shift unpredictably.
To wrap it up, what key takeaways should we remember?
Understanding the complexities of interpreting market data, especially from sources like the PPI, highlights the need to remain alert. Strategic thinking and adaptability will be crucial in these turbulent waters.
As we close, we'd love to hear from you. How do you see PPI reactions influencing our market trends moving forward?
Let's get straight to the facts in the comments. Your thoughts might just influence the next conversation about these exciting market developments.
Time to navigate these turbulent waters. Let's dive right into today's hot topic. Not since the lows of 2022 have we seen the Nasdaq make such significant moves. What does it mean for traders and investors alike?
Exactly. It's all about the gap fill achieved by the S&P 500, significant global stock rebounds, and considerable dark pool transactions in Nasdaq shares, particularly with Nvidia making waves.
So what's the golden nugget of wisdom in today's show?
Today's key thesis is that this surge in stocks, especially fueled by Nvidia's performance and overall markets trending upward, reflects critical shifts in trading sentiment and investor behavior. What does this signal for future market trends?
First up, explain this whirlwind of recent activity.
In recent days, we've seen the Nasdaq break past previous resistance levels, particularly driven by massive trades within semiconductor stocks, a clear indicator of large investors making strategic moves.
What does the mood of the market look like right now?
The current sentiment is intriguing, indicating a potential downturn of around 10% for the Russell 2000. The bulls and bears are at a critical juncture, potentially signaling an upcoming market turning point.
And what about inflation?
Current readings show core CPI might be easing, but economists warn it remains a notable concern. There's buzz about potential rate cuts that could shake the markets profoundly.
What's on the horizon for volatility?
The market predicts increased volatility as the Federal Reserve manages inflation data. We're on edge, as these dynamics could lead us down a path toward bearish market conditions.
What about the upcoming elections? Any potential implications for markets?
Absolutely. The impending elections could significantly steer market directions. Investor confidence may hinge on which policies are favored, definitely something to keep an eye on.
To wrap it up, what's our key takeaway?
The convergence of market activity, shifting sentiment, and external pressures creates a complex trading landscape. Traders must remain vigilant and adaptable as conditions evolve.
How should traders prepare for these evolving conditions?
Staying informed on inflation trends and the Fed's movements will be critical in navigating this landscape. It's a boatload of information to manage.
As we conclude this segment, we're curious. What strategies do you believe traders should focus on?
Drop your strategies in the comments. We want to know how you think navigating these currents should be tackled.
Let's dive right in. Today's discussion tackles the current state of the global economy and financial markets, as we've got Gordon Long back on the show. With the U.S. federal debt surpassing $35 trillion, is now really the best time for investors?
Absolutely. Gordon's insights suggest that amid the troubling signs, unique investment opportunities are arising. His extensive background in market analysis equips him to help us navigate these waters.
What's the major thesis of this conversation?
Gordon emphasizes a paradox. A rising debt crisis could lead investors to unprecedented opportunities. As alarming as the debt growth is, knowing how to invest strategically might just pay off.
That's a staggering number. Tell us more about the record national debt.
Yes, U.S. federal debt is currently soaring above $35 trillion, and when you include households and businesses, we're talking over $100 trillion in debt. This raises big red flags regarding our economic stability.
So what's the silver lining for investors?
Gordon notes that while the market is volatile, astute investors who prepare and manage risks effectively could uncover very profitable opportunities. Historically, markets tend to bounce back.
Interesting. What does Gordon mean by creditus?
Creditus signifies a system where economic growth heavily relies on borrowing. Evaluating how this affects GDP and the sustainability of both credit and debt in the long term becomes crucial.
What does Gordon predict for the future of financial markets?
He anticipates a significant shift towards a command and control model within our economy, where governments direct capital flows into specific sectors, such as renewable energy and infrastructure, making it critical for investors to adjust accordingly.
And regarding inflation, what should we be prepared for?
Gordon warns that inflation could escalate due to rampant debt growth. Investors should focus on hedging and investing in physical commodities or real estate to protect purchasing power.
What's the final takeaway from Gordon's insights?
Investors are advised to remain proactive. Hard assets like commodities are key in navigating potential economic turbulence ahead. It's all about preparing wisely and adapting to the changing landscape.
Final thoughts. What do we need to remember?
Despite the grim debt forecast, with strategic planning, there are unparalleled opportunities for savvy investors. The balance between risk and reward is crucial. Know when to act.
And there you have it, folks. We've been given insight into the complex financial landscape from Russ Hutchinson and Chris Vermeulen.
That's right. Hutchinson alerts us to the alarming rise in delinquencies, which could shadow even bigger problems for our economy.
And Vermeulen makes it clear we need to be ready for potential margin calls, which could create chaos in the markets.
Exactly. While they agree on the risks, they offer different strategies to navigate this landscape, keeping us on our toes.
This discussion certainly highlights the urgency and significance of understanding these indicators.
If you found this video valuable, don't forget to give us a thumbs up and subscribe for more insights as we keep you informed on this ever-changing market.
Thanks for joining us today. Be sure to explore our other content for more strategies to secure and grow your investments.